Leading us into the weekend now is Gary Wagner. Chart This is up next. Happy to see you, Gary, because it means it's Friday.
My pleasure as always, and as we say on the islands, happy Aloha Friday to everyone.
Gary, last week when we spoke, you were looking for the 1268 level to hold for gold. What are you looking at now?
Well, it's been an interesting week. It does seem as though we have held those lows, and we actually saw a break above $1,300. The key is that this market is really being driven by geopolitical factors along with economic factors. And when you have geopolitical factors kind of added into the mix, you can see a tremendous increase in volatility. And I think that's exactly what we've seen. In other words, when there was the belief that the tension in the Ukraine between the Ukraine and Russia was escalating, that's when we saw the market really spike up. When there was talk about the fact Putin mentioned, I believe on Wednesday, that he was moving his troops off the border, we saw the market come down $17 or $18. And then it got very, very quiet after that. So we're really seeing a market that is being driven by events as opposed to economic factors alone.
Now, Gary, we had Jim Rogers earlier on this week who said, look, it's not unusual if we were to see a 50% correction in gold, considering the 12-year bull run it's had. What do you make of his remarks?
Well, it's an interesting comment. There's no doubt we saw the market have an incredibly tremendous run. And in fact, the last 4 years of that 12-year run, we witnessed the market going from 700 and then topping out at about 1900. 50% can happen. That's certainly not something that is in the impossible category and still be in a bullish mode. I think that is what he was saying. However, my belief is that 61% should hold.
So in your insert last week, Gary, you looked to see whether we sustained any long-term critical chart damage. I guess my first question is, did we? And B, what have you brought us this week?
Well, first of all, the good news is I do not believe we have sustained any critical long-term damage. But what we're going to be looking at on today's video are signs whether or not we have a base forming in this area and where our particular support and resistance areas are. Because the market did have the ability to trade over 1300 and in a technical sense, that's not as important of a number as a psychological sense. All of those century marks are. And so with the market hovering right around there, I would feel more comfortable on the bull side seeing the market trade back above 1300.
Excellent, Gary. On that note, let's get to it.
On today's insert, I want to look at the current price of gold, the fact that we have been looking for some signs of a bottom formation, the beginning of some sort of a rally, and the actual outcome of what we've witnessed, try to make some sense of it. I'm going to start by looking at a 320-minute chart. Let's go ahead and compress this a little bit because there's a couple of things that we have noticed. Now, first of all, we have had pretty eloquent, adequate bottoms form in the marketplace in which it would trade off of the highs. In other words, we'd come down, reach a low, have some sort of a rally. We've had these two occur, or this occur twice, However, and of course over here, but on all occasions, the market itself over these last rallies, unlike this rally, which really took us from when we consider the market's trading at 1275 to 1330, a nice little spread. These last couple of rallies have only been rallies of $20 to $30. On the low end here, call it 1270 up to about $13 here, and I'm kind of taking these lows out here at around 1280 up to about what, 13, I believe 13.15 in terms of the high. Now, the one thing that we have noticed, though, that kind of differentiates this market, let me go ahead and compress it. And what we have noticed, and this was actually pointed out by one of our Chart This viewers, and it was quite obvious once I took a look at it, but if we draw a resistance line that simply goes from these tops, these most recent tops, it's quite clear that this last run, we absolutely had some sort of breakout. We did break above this short standing resistance line. First thing. The second thing that we are noticing in terms of disposition of this market is the fact that on the last 3 times this market has sold off, in other words, this low to this low to this low, we have had a succession of higher lows. So when we consider the fact that we broke above this resistance line, we've had a series of higher lows, and this last low, at least as of now, and this was recorded on Thursday night, we can see the market's trading quietly, 1291, but it is effectively trading above this resistance line, and that is another positive note. On the negative side, we have noticed that we have had some real resistance. 1330, of course, that's the resistance we need to take out. We've got 1300, I believe 1302, and about 1313 here. So, although we had a lower high, market comes down. Once it hit this low here, and this low here I believe was 68, at 1268 we had a series of higher lows and higher highs. Now, the other thing that we're noticing in terms of just straight observation of the market is, unlike many occasions when gold is trending solidly to the downside or trending solidly to the upside, when it does that, even in a standard candlestick charts, on the downside you get a majority of red candles as it moves up, a majority of green candles. It's even more apparent if we convert this to a Japanese average chart. We'll do that in a second. But what we're noticing over this last, call it approximately 2 weeks to a month, is that we've actually gone into a fairly dynamic but a range in the market, on the low side at around 1270 and the high side just above 1300. But what we're noticing is, look at the color combination of these candles. Rather than getting a succession of green candles, and then of course you will get small bouts of retracement here, but you'll get a succession of green and then green, here's sideways action. It's during a sideways markets that you get the market alternating from green to red. However, you're getting these short down days and then spikes, short down days and then spikes, effectively giving you a dynamic range of the top and a dynamic range of the bottom. So we really want to see this market absolutely has to break out of this range before we can say any kind of rally is in play. Now, for those who want the most up-to-the-minute viewpoint of the gold market, I suggest you go to our website, thegoldforecast.com, and if you're not already a member, simply sign up as a member of Chart This after the show. It's absolutely free. If you click here, there will be a link to actually go in and create that free account. If you already have an account, please simply use the user login to go to the after the show page, and that will give you our most current content available. Now, for today's after the show, because we won't be around next week, I want to give you the most up-to-the-minute information that I can, and so we will be allowing you to view the weekend review, which is what our paid subscribers would be getting on Friday also. This will go onto our site live by 6 o'clock Eastern Standard Time. Up till then, I might include Thursday's show just prior to that. Again, determining what it takes to actually break out and whether or not we're seeing any kind of a genuine breakout or a market trading sideways.
Gary, as always, thank you so much.
My pleasure, and I want to wish all of our Chart This viewers a great weekend and prosperous trading and investing next week. We'll see you real soon.
Gary won't be back next week since Kitco News will be in New York covering the Metals and Minerals show, but we will be back in 2 weeks' time. Thanks for watching.